Well, good morning, everybody. Today we're fortunate to have Sharlene and Jarrod both from REI Super. I guess it always makes me think about superannuation when I was started out in my career, and people talk to me about superannuation. My eyes would glaze over when I was in my late teens. And as more and more grey hair has appeared on my head, I've become increasingly more concerned about superannuation, and regret a lot about not listening to those folks when I was a lot younger. Jarrod, you're going to lead off first, but just by way of some introduction, folks, Jarrod's had 20 years plus in the finance industry, and I know you've had a broad career. You've worked at Macquarie Bank, ANZ, Westpac, and also Cbus Superannuation. So, Jarrod, there's not much you don't know, I would have thought, about money. And Sharlene is 25 years in the finance industry and with REI Super. And I also note that you now are an accredited trainer with ASIC, which is a tough course to get through, Sharlene, with be money smart. And I know our friends at ASIC don't hand out things very easily at all. But Jarrod, I'll hand over to you, and you can walk the folks through superannuation, and no doubt the market will appear on everybody's radar right now, the turmoil that's going on in that space.
Right, thanks, Tim. It's terrific to be here. Look, I have a similar view of super. I think most people only get interested in super in their 40s when they suddenly realise that at some point they're going to have to retire, and my goodness, have I got enough money to retire? So I'm in that, I wish I'd thought about super when I was a younger banker and had more money, but I'm in the same boat as you. I think I've been fortunate in that I've been was a banker for 20, 25 years, and worked through the GFC at one of the big banks as a senior exec. And so you might just start to give people a sense of how we see the economy in broad terms, both here and overseas, and a little bit of comparison to how does this recession, and there's no question we're in a recession now, how does that compare to the GFC, which everyone has got a reasonably recent experience of. If I compare it to the GFC, this particular pandemic-induced economic disruption is better and worse than the GFC. And I'll sort of briefly explain that. It's better in the sense that the GFC was caused by large-scale disruption in the financial services sector, very, very serious liquidity problems, and the collapse of a major number of banks. And then that washed out through the economy. So the essence of the GFC was a collapse in the financial system, and that's why it made it so difficult to deal with and took so long to get through. This is a very different situation. This is a combination of obviously the pandemic, which has caused economic shutdown in every industrialised country, and an oil price shock on the side, but just to make things worse. And what does that actually mean? It means that we will see, I think, the greatest contraction in global GDP since the 1930s depression. There's no question that's going to happen. There will be rolling recessions around the world. Australia is in a recession now, as are all of the major Western economies, and China's in one as well. There has been incredible fiscal stimulus policy response from federal governments around the world. If you look at the US, the fiscal stimulus in the US is almost 3 times the stimulus that they applied during the GFC. So we're seeing very, very rapid shutdowns in economic activity, and we've seen very, very rapid fiscal and monetary policy responses from governments. And when I say monetary policy, interest rates are going to stay at virtually at zero level, very low or zero levels for the foreseeable future. The cash rate here at 25, that's not going to change, and most of the central banks will facilitate quantitative easing if they need to, which is printing money to keep the cost of credit down. So that's not going to keep us out of recession, but it's going to avoid any long-term systemic risks throughout those economies. And what will happen is very short, very sharp, very damaging recession, but also a very quick correction. As soon as social distancing measures come off, the economies will return to growth very quickly, and that's been the experience in most recessions. What does it mean in terms of super? The Markets have been incredibly volatile. If we look at equity markets, which is what you'll see on the news every day, equity markets have been extraordinarily volatile, the most volatile we've seen in our lifetime. And so what that means is we've seen incredible falls and incredible rises. So on the 16th of March, we saw the biggest one-day fall, which is just shy of 10%. And on the 30th of March, we had the biggest one-day rise of 7%. And so the market is bouncing around all over the place. And it's bouncing around because it doesn't, the risk of the depth of the recession and how long it's going to take to work through is unknown. And so that's why the markets are volatile. And there are also questions being raised about, are there particular industries that will suffer long-term structural change as a result of what's happened through this pandemic? And we're talking about large-scale retail, travel and tourism, and airlines, because you've obviously seen virtual flaps here. So there's a combination of everything's going the hell in a handbasket one day, the next day the economies are opening up again and everything's okay. So we're sort of bouncing backwards and forwards. So what does that mean for your super? I think the important thing to remember about super is that it's a long-term investment. You have, because of preservation, you have a very long-term investment horizon. For most people, the average person, they've got a 30-year investment horizon. So you don't need to be making changes now. You don't need to be changing your fundamental strategy or how you've allocated your assets amongst different asset classes. You don't need to do any of that now. I deliberately haven't looked at my super balance. I'm happy with the strategy and I'm not bouncing around to change it now. And I'll come back and I'll talk later on about two things to be very, very careful of in this situation, in this environment, which is switching your super investments between different asset classes and the early release payment process that we're going through with the government. I'll come back and talk to those. It might be good, Tim, just if you could give us a sense of how you're seeing the property market and the real estate industry as we work through this crisis.
Yeah, it was very interesting to hear your last comments there, Jarrod. I remember in an office somewhere with good folks like yourself and some of your colleagues some years ago, and up on the wall, this gentleman had that a market is a place where impatient people transfer money to patient people, and we're hearing about people now saying, "Oh, I think I should sell my property, or I should do something with my super, or something like that." They have, if they do that, they're selling, at least in the super area, I would have thought at a very, very low market. So at the risk of giving financial advice, and I'm certainly not, but it strikes me that if you were to do something now to sell equities or for that matter take money out of your super, you're doing it at a time when it's very, very low. So unless you have to, it strikes me as an uneducated individual as in these things not a good time. But I'll leave it for you to correct me. In relation to the property market, I think it's to some extent still guesswork. It's when the COVID first bit in, and we shut the market down, so to speak, at auctions. Now, I see auctions a bit like taking the pulse of the market, because all of the transactions, by the time they come through, and the bodies that report on transactions give us the data, they're 6-8 weeks old. So they're not a lot of value, but the auctions is here and now. So I take a lot of guidance from auctions. Now, when the auction environment was shut down and we couldn't have face-to-face auctions and these sorts of things, what happened then is the number of auctions decreased quite sharply. That was the first thing. And in addition to that, we saw that as a consequence of people participating in auctions in the online environment only, that the clearance rate went down to, I think it was around 40 or sub 40%. So that looks horrific. But last weekend, when we went back to a more traditional auction environment, it came back up to 70%. So that is of itself quite interesting. And the prices that were being achieved in that space, people were happy with. Obviously, if you've got a 70% clearance rate, people are happy with the price. So I at this stage don't know really what impact it is going to have. I mean, people were talking about a lot of distressed assets coming onto the market. Maybe they're right, and maybe that exists in our future. But right now, I think it is too early to call exactly what's going to be the outcome. And the wild card in this for me is once we open up the economy again, just how fast we're able to recover. Now, the Reserve Bank was talking about us losing X percent of our economy, which was not surprising, but they're predicting that we were going to come back in reasonably strong as well. So again, I don't know whether those predictions are going to come through. And I guess the other thing here, Jarrod, is, and this is a question for you, is whether or not Australia is insulated from the rest of the world. I suspect not. We're a minnow compared to the likes of the US and China. So even if we have all the right economic policies, that may not, I would have thought, not be able to rescue us going forward.
Yeah, it's an interesting question as to how quickly we come back. And the unemployment statistics which came out yesterday, didn't look too bad. Unemployment up to about 6%. But if you look behind the numbers, as of yesterday, there's just over 1.5 million people on job seeker, so unemployed, and there's 6 million Australians who are receiving the JobKeeper payment, which is the federal government policy through employers. So that means that there are more than 50% of the active Australian workforce is currently receiving a federal government payment instead of income. Now that is clearly not sustainable for anything other than the absolute short term. So I think this trade-off between cases of COVID-19 and the damage that's being done to the economy will be forced to a very rapid conclusion, and that's what we're seeing in other countries. The question around how's the Australian economy affected differently to others is interesting, because there are some sectors of the Australian economy that will be relatively unaffected, and there's some sectors that will be worse off. And I'll sort of briefly touch on those. The first economy to come out of recession will be China. China factories are opening, iron ore sales are up. So the major product markets for our exports that are based on extractive industries, which is China, will be fine. Iron ore prices are at an all-time high, supported by low oil prices. So that part of the economy will be fantastic. The pieces of the Australian economy that will be a problem, particularly in my home state, which is Victoria, our biggest export industry here is education, and a large part of the Chinese market. And so overseas students, who are a very, very big driver of economic activity here and in New South Wales, that might be 6 or 12 months before we start to see that. So that's going to be a much more significant hit. And the third piece is across all of the eastern seaboard states in Australia, our underlying economic growth has been underpinned by a very high net migration rate. And at the moment, that's 0. And the forecast, I was listening to Alan Tudge, who's the acting immigration minister last night, and we're going to have a very, very significant drop-off in net migration for the next probably 2 years. And so that's a driver of economic growth, particularly in the building and construction and property industry, which is why we're seeing sort of new housing sales drop off. So I think it's going to be a story of two economies. There'll be those economies which are exposed to global trade, which will recover, and there are some particular, and of course, obviously airlines and travel and tourism in Australia. I think the borders here are probably going to be shut until well into next year. And so, the travel and tourism industries that Queensland in particular survives on will be badly hit. So I think you'll see a two-speed economy, and there'll be some jobs there that won't come back for 6 or 12 months.
Yeah.
So I think just sort of touching on super, the one thing that people always ask me is, how bad is my super doing? And I think you need to be really careful, because when you watch the news, you only ever see the S&P or the ASX 200, the two big indices for listed equities. And the reality is most people's super isn't just invested in the Australian market or the US equity market. It's invested in a balanced portfolio which has a whole range of asset classes, and they've all performed differently. And the reason you invest in a diversified portfolio is that they're counter-cyclical and they don't always move together. So if you look at, I'm just looking at our numbers for the last 3 months. If you look at Australian shares that are down about 27%, the balanced portfolio is only down 12% because it's got a whole series of other assets. It's got bonds, it's got cash, it's got unlisted property. Unlisted property is only dropped by 5%. So you've got to just take a step back and say, it's not actually the ASX movements that you see on Channel 9. That's not, your super's not doing that. Your super is being cushioned by the fact that you've generally invested in a whole range of diversified assets. And that's an important thing. If we talk about switching, I might just, there's one slide here, we just flick forward to that first slide. And one more, please. What we've observed, we've had a lot of queries from members about should I switch from a balanced portfolio or a growth portfolio into cash. We've had probably hundreds of queries around that. And what we know from previous market corrections is, as you correctly pointed out before, Tim, switching out of equities after a big market correction when you don't have to is the equivalent of selling your house at the bottom of the property market when you don't have to. It just doesn't make a lot of sense. And we do know from history, people who have done that in the past never recover it. So if you're looking at your super today, and everyone's super fund will have gone backwards in the last 3 months, it's an unrealised capital loss that's sitting in your account, but it's not realised, it's a paper loss. The only way to realise that loss is to switch out into cash now. And we know from previous times, people who have done that never make that money back up because it's gone. You realise the loss now, you reinvest in the market generally when it's climbing, and there's a dead weight loss, which as you point out, has been transferred to patient investors. So I know it's difficult for people and it's distressing, particularly those who are getting close to retirement, but you need to be patient and not jump ship at the bottom of the market. And that's a dangerous thing. We might just talk briefly about the early release scheme too, which is obviously most people are aware of. There's been 2 policy activities or policy changes in regard to super in response to the crisis. One good, one not so good. The first one is the early release scheme. The early release scheme is available to individuals who meet a series of criteria, basically have had their hours significantly cut or become unemployed. And then enables them to take $10,000 out of their super prior to 30 June and $10,000 out of their super post 30 June in the next financial year. And we would just caution people to do that as a last resort. There are certainly people who are in desperate financial position and it's the right thing to do. But if you're not in a desperate financial position, be very careful because there's a double whammy in taking money out of your super now. Firstly, you're taking it out of the bottom of the markets, which we've just talked about, so you're locking unrealised losses. But the second part is if you're taking it out now, you lose all the compounding value over time. And the younger you are, the worse the effect. If we flick through to the next page. So this is conservative. I think this is conservative now. So if you take 25,000 out and you're 25, it makes $100,000 difference in your balance at retirement. So you take 20,000 out now, you'll never make it up. You'll be $100,000 behind. And so we caution people to think very carefully about using the early release as a way of bolstering cash. Certainly, if you're in desperate straits, you should do it. And we're making those payments. We've had some members who have done it, and we're doing everything we can to get the money to them as quickly as possible. But if you don't have to do it, be very, very careful and at least talk to someone. Call us. We've got our call centres operating 1,000 miles an hour. Or get some independent financial advice about what you're doing so that you understand the impact on your retirement income of taking money out now. So they're the 2 sort of key messages. The third one is for those people who are in the pension phase, the government has reduced the minimum withdrawal requirements in pension phase, which is actually good policy. It just means that you don't have to take your 5% out at the bottom of the market. So that's actually a good policy, but it's only for people who are in that pension phase. So that's sort of the 2 key messages. But I think the overlying message is please call us and talk to someone to get some advice first before you do that.
Yeah, that's a really interesting point because you'll often hear people say, "I've made so much money on this investment property, or I've lost this amount of money," and neither of those things are true unless you sell it.
That's right.
And I think that is a really interesting observation that people should be making. And I also found interesting about leaving the money in there or taking out that $10,000 because I remember quite a few years ago now when I had when I was in my 20s and I borrowed, as we have to do then, a great chunk of money to buy a house as you had to do. And so I put it into a spreadsheet just to have a look at how it all worked. And it was quite amazing that if you put in $100 on your very first repayment and let that run all the way through the system on your 25-year mortgage, it was a fascinating outcome about what impact that $100 had on the amount of interest you paid and how quickly you paid it off. I forget now, but I think it might have been something like 6 months or something crazy like that. That impact all the way through.
Yeah, I mean, and Super's exactly the same, Tim. I mean, I'm sort of counter-cyclical, so I've actually put more money into Super as a voluntary post-tax sacrifice because we got to, somewhere approaching the bottom of the market, and so I actually put more money into Super. It's a good time to put it in. But which is okay if you can afford to do that, but you can also make smaller incremental contributions. And so if you put an extra $20 a week, say you're a 30-year-old and you put an extra $20 a week, which is actually not a lot of money, that's sort of $50,000, $60,000 more in your retirement savings because it compounds. It's the same thing. So the earlier you start, the better. And I tell my kids this, I've got one who's got a small super balance, and I said, when you get a chance, rather than, it's what's difficult telling boys not to spend it on cars and things, but if you get the chance to get it in now and just leave it there, it makes an enormous difference because you've got a 45, your 20-year-old, you've got a 45-year investment horizon and 45 years of compounding. So I know it's a hard time with cash flow, but it's always a good decision to put a little bit of extra money into Super if you can.
Yeah. So on the television quite regularly, we get these signs, don't we, about we should be in an industry fund. Can you give me some explanation as to why that is?
Yeah, I can. I think, and so I've come from big financial institutions, and so industry super is very, very different. And the way I try and explain it to people is, when you work in a big financial institution, a big bank, there's three competing stakeholders. It's the shareholder, it's the staff, and it's the customers. And whenever there's a trade-off between customers and shareholders in big financial institutions, as we've seen through the Royal Commission, shareholders always win 100% of the time. So it's always about the shareholder. And, they'll tell you it's not. They'll tell you it's about the customer, but it's not. Banking is about shareholder returns and return on equity. And they apply the same logic to when they run super funds. The industry fund business, if you like, doesn't have that conflict because our shareholders are our members. We don't have external shareholders. We don't have return on equity requirements. We don't have to pay anyone that owns a business. So every member effectively owns the super fund. And so everything we do is just for members. There's no point making a profit because it goes back to members anyway. So we've got this cycle, and what it means is you get much better decision process. So the way the system works in Australia with preservation, we've invested in a whole range of fantastic asset classes, and we do it at low cost. And so everything we do is designed to reduce fees and lower the cost of members because we've got no incentive to do anything else. And so I think that's the fundamental difference between the industry fund model and the for-profit model. Some people argue that you shouldn't have for-profit businesses in superannuation. And certainly the way our fund works, and I work at CBUS as well, it's all about members and minimising costs and getting the right investment returns. So I think that's the fundamental difference between industry super and superannuation in one of the big. Yeah. Well,
that makes perfect sense. I mean, if you don't have any shareholders to pay dividends to, then the shareholders, I suppose, effectively become the members of the fund. So yeah, that makes perfect sense to me.
Yeah, that's right. I mean, if you look at the balance sheet of a super fund, we've got operational reserves, and then we've got admin reserves, and those reserves are owned by the members. At the end of the day, each member has got a slice of that reserve, so there is no shareholder. And I think that's why we have it's a better model. And certainly, if you look at the governance structures, like our board, for example, is a combination of independent directors and member-elected directors. So the directors on our board are elected by the members. Most of them come from the real estate industry, so everything we do has a member focus, but it also has a real estate industry lens on it.
Mm.
When I sit down at the table, we have people who are currently running real estate businesses, and they're directors of the fund. So that's the other interesting part. That's the industry part of it, is that funds that are very strongly aligned with industries like we are, most of our members are in the industry, most of our board has been or is in the industry, and that creates a very different set of discussions at the board table. Good discussions. Yeah.
So if you are young in coming into the industry, then would you be more inclined to be taking on greater risk in your investments, knowing that you could ride it out, but as you advance in years like me, you'd be starting to change your investment strategy within super? And do we have the flexibility in there to make those decisions?
Yeah, I'll be very careful not to offer individual advice, so my comments are only general.
Yep.
But certainly there's a very strong philosophy that when you're young and you've got a long investment horizon, you have the ability to go through a whole series of market cycles, and that means that you can have an asset allocation that is skewed towards riskier assets that will give you better long-term returns, and they're generally what we call growth assets. That doesn't mean you shouldn't have a diversified portfolio, but you can have you certainly don't need lots of fixed interest and cash sitting in your portfolio if you've got 45 years. So so when I talk to my son who's 20, he's in 100% growth assets because he's got 45 years to worry about it. He'll probably go through 4 or 5 different equity market cycles. Now, the question changes as you get closer to retirement, and it becomes a question of, if you have sufficient funds that you're not really drawing down on your capital, you can probably stay fully invested in growth. If, however, you are going to start consuming your capital as you move through retirement, then there's a logic to say, okay, well, I'm going to take a slice of that into cash or fixed interest, so that I've got a couple of years consumption lined up, and that way, if we do get a bump in the market like we've got now, I don't have to be selling at the bottom of the market. So you can shift your asset allocation to give yourself some insulation from the market and fund your consumption for the next 2 or 3 years. And that's what you see in a lot of portfolios, that you get to that retirement age, you take a more conservative position, not because you don't tolerate risk, but you've got a timing problem, and so you insulate yourself from that timing problem. And that's a good strategy.
I promise this will be my last question. So I'm going to go about being in super to then being retired, and there's a lot of self-interest here. But it's I think I would be okay. I think I'm disciplined enough to be able to do something with my super payment, but to guard against me having a rush of blood one day, I like the idea of getting paid a salary in retirement. So to take my super lump sum, and rather than have it sitting there staring at me every day, tempting me to do something with it, I'm wondering whether or not and again, just a general comment from you. I'm not looking to you to give me advice here, but it strikes me that there are products that you can put your money into, and it continues to pay you a salary, if we can call it that, going forward. So I manage my affairs. That is something that I'm considering.
Yeah, look, and it's an excellent question. And so what I intend to do, so this is just my view of the world, it's not personal advice, is you can take it as a lump sum, and then you feel obliged to make some investment. It's still a very tax-effective investment, leaving in super, and the best way is probably to move to an account-based pension where you take a percentage each year, and it goes into account, and you can draw it like a salary. And so there's minimum withdrawal rate. So if you're 65 to 74, which is the start of your retirement phase, you've got to take out 5% of your balance. And the balance that you can convert to account-based pension is limited. So you can do 1.6 million per person, or 3.2 per couple, and that's indexed at CPI in sort of $100,000 lot. So what we see a lot of members doing is saying, I've got my super, it's in an accumulation fund, I've gone through a transition to retirement, I'll move it to an account-based pension. I can change effectively the salary, if you like, that I draw off by changing my withdrawal rate, and then I just take it that way, and the rest of your super continues to earn and reinvest, and you just take out that slice, and it basically effectively replaces your income with an account-based pension, and that's a really common product. We've got one. Every industry fund has got an account. You don't have to go and do an exotic annuity-based product. You can just do an account-based pension where you just take a percentage each year, and I think that's a sensible way, because it means you can adjust it according to your circumstances. So you know that if in 3 years' time you can have a big year of overseas travel, and goodness knows when that's going to be, you can up the withdrawal rate for that year. So that's a good way of doing it. Safe way of doing it too.
Right. All right. Well, I think that's all of my questions. Did you have anything further, Jarrod, that you wanted to advise our listeners with?
Only, it's been a busy time for superannuation funds. We've tried to help members by putting everything in one spot. So on our website, we've got a COVID-19 hub, if you like, and that's got all sorts of information around early release, around JobKeeper, JobSeeker, all sorts of bits and pieces of information that, because I think people would get a little bit overwhelmed with the volume of information in this day and age. And so please go on the website and have a look. It's a COVID-19 page. It's got everything that we think is helpful and useful. And secondly, I think if you are worried about it, just ring up and call. And we've had lots and lots of calls. Our call volume going through our call centre for members is 2 or 3 times what it would normally be. It's sort of 600 to 700 calls a week versus 200. Which is fantastic. So it means members are worried and they're nervous and they are concerned about the future, and they're calling us. And most of the calls we're getting are, what's my balance? How's it going? What should I do? Should I switch? And so that's actually fantastic news. The more people that call, the better, as far as I'm concerned. So if you're feeling uncertain, go and have a look at the COVID-19 page, but just give us a buzz. Have a chat to us.
All right. Well, thank you. Thank you very much. Sharlene.
Yes.
I just remind everybody about your Be Smart Money training. So I guess there's no better time to be looking at things like that in our world. Given the rate of unemployment, I have to say Jarrod's comment about Australia not being as adversely impacted by the world economy, and given that our major trading partner is China, and they're coming out of recession, so whilst things are unlikely to be totally rosy going forward, we will need to be somewhat careful with our money and how we spend it, and so that could be something we touch on here maybe.
Absolutely. So what we offer are, back in the olden days, I would do face-to-face workplace sessions around super and that type of thing. Now I tend to do it exactly like this, go into workplaces via Zoom and give a little bit of a webinar around the early release, around building up your super once life gets back to normal, how to minimise the tax you're paying on those nice commissions that you will one day again earn, that type of thing. How to save more tax effectively for your first home deposit. So yeah, when life goes back to normal, we can do that face to face. But it's a really good idea in the meantime, if any workplaces out there or anybody individually want to give me a call as well, more than happy to do those sessions one-on-one or to a group. It's really, really important.
It seems to me to be very complicated, and I know that some people who have come out of jobs similar to yourselves, or even amateurs in this space, spend a lot of time trying to get the maximum age pension, because that's something that they see that is so important to going forward, and it seems to me that structuring your financial affairs properly after going into retirement means that you can maximise your entitlement to some of the government pensions and the like.
Absolutely, and that's a really common question or subject that gets spoken about when I have these conversations. So people are always like, oh, I don't want to sell my house, I don't want to lose my pension, I'll have too much money in the bank. So the average age pension, I think, is around the 20,000 figure per annum. And if you're going to sell your house for $1 million or $1.5 million or whatever it might be, I don't know what house prices will end up looking like. That's significantly more than what the age pension is, but it doesn't mean you're going to lose it necessarily. It could mean that you'll get a part pension and then you can top up your super with the proceeds of the sale. There's, and this is really handy for real estate agents to know anyway, because this could inform conversations that they have with potential vendors, is that there's a thing now called the downsizer, where if you're selling the family home, you can top up your super, which can top up the age pension. So you can have that salary that you were talking about paid to you that supplements the age pension. And usually that's a really good each way bet. Super's been really successful since it was implemented universally in 1992. So more and more people I can't remember the percentages, but it's close to like 30-40% of people are not relying solely on the age pension because they're supplementing the age pension with the super pension on top of it. So lots of ways to do it. The downsize is just one of them. Yep.
Yeah.
Some other things, I've been having some chats with people since this is all hit. So some things that have come out in the conversations, I think it's really important more broadly to get out there as well that affect your super, is conversations around the early release of super versus a home loan repayment holiday. And long-term results on super tend to average around the 7%, depending on which fund you're in. At the moment, interest rates on your mortgage are high 2s, low 3s, and the government has pretty much said that they're going to remain low for a really long time. So if you're looking at this compound interest thing, you've got a home loan holiday for 6 months on your mortgage at, say, 3% for argument's sake. That's going to compound for a little while, not for very long, because after the 6 months, you're going to start, most likely, hopefully, making principal and interest repayments on it. So you're going to get that back down. Whereas if you take that money out of your super over the long term, if you've got 45 years of work left, or 40 or 30, that's probably going to exceed the length of time you've got left on your mortgage. You're going to miss the compound interest returns at, say, 7% if we go back to what it used to be. So we're having conversations with people around that. So that's really important to weigh up. And another thing people may not be aware of, if they pull the money out of their super, they could lose access to insurance. And oftentimes the only insurance people have is inside their super, and often they don't even know they've got it. So that's another really good thing to think of, because if you get sick now and you can't work, you really don't want to lose your income protection. You really, really don't. It's quite important. And another thing that people may not know about income protection is that usually it's 75% of your average, of your last 12 months income. Because we tailor it specifically to the real estate industry, and I guess this is a reflection of the makeup of our board coming from the industry, is that we look at the last 3 years average income when we pay that out. So it would be 75% of that plus an additional 10% going onto your super, so that doesn't, your future life doesn't take a hit as well. So really important to have a really good look at the insurances before you make the decision to recommend.
That's a really good point. So that insurance is paid to the insured in the circumstances where the policy will respond to the insured's circumstances, but that's not coming out of their super.
The premiums come out of their super, so it doesn't affect your day-to-day cash flow. But the payments come from that's our insurer. The payments don't actually come from their super.
Right.
The payout does not come from their super.
Okay. Well, that's something I wasn't aware of, and I'm a member of your fund, so that's interesting that that entitlement is there.
Yeah. I'm a super nerd. I genuinely love super, and I know that's a really uncool thing to say, but The reason being is once I was a single mum with 3 kids and it was all up to me. So I got a little bit scared if something happened. And then one day I did get too sick to work for 6 months and I would have lost my home if I didn't have the income protection inside the super. So I bang on about this all the time purely because I would be in a really different position right now if I hadn't have had it. And with COVID and everything going on and jobs and all of that kind of thing, you just really want to make sure you're protected, I feel.
Yeah. Yeah, interesting. It's certainly worthwhile making yourself aware of all of the things that are happening in your space. And I have to say, as a member of the fund, don't apologise to me for being a super nerd.
Thanks.
I have another question for you, Jarrod, if you don't mind. One of the comments that have been made about the government stimulus package is that they've got one go at this. So their JobKeeper, we're talking about that. Was that the best move? But if there isn't this money tree, as our treasurer constantly tells us, so have they spent the money in the right place? Is that in your view where it's going to be best applied? And obviously it can't continue to go on. The media has been making much of the Treasurer's prediction that we would be in surplus, and now it has turned into a position where the country's never been in so much debt. So have they spent the stimulus, in your view, in the right spot?
Yeah, look, it's a very interesting question. My view is yes. I think income support is a very effective way of directly maintaining economic activity. And it's also the right thing for people who have still got to pay utility bills and put food on the table for their families. So I think you know, and it was at a level that I thought was higher than I expected. I didn't expect JobSeeker to be as generous as it was. So I think absolutely yes. But it's coming at a very, very significant cost. And so what that means is that you can only, you know, you've got some politics around how long it's going to go for. And the reality is we want it to go for the shortest time possible. We want the economy to reopen as quickly as possible without causing mass outbreaks of this virus. So I think it's actually good policy. I'm not sure early release on super is a great policy for the reasons that I've talked about. But I think for a certain small portion of the population who perhaps don't have access to JobKeeper, maybe early release of super has helped them over a brief hurdle. But no, I think it's a good stimulus package and it's been well targeted. But we've got to have a view of coming out the other side of it. The other thing people should know is there's also we've had a very aggressive monetary policy as well. So you've got the cash rate at a level it's never been at before, and the Reserve Bank comfortable with quantitative easing, which is what we saw in America during the GFC. So quantitative easing is a very, very efficient way of reducing credit costs. So I think they've got the balance right. But the question is, yes, every week that this goes on adds to a federal government deficit that will have to be paid back. The advantage being the interest rates are so low that the deficits are not as damaging as they would otherwise be. But it's got to stop at some point. That's right.
So I think we're all hoping, aren't we, that everybody in our economy, all of those people who are locked down and not spending money, once the constraints are removed, we want them out there enjoying the world. I found entertaining the other day on the news or a program talking about COVID-19, and there was the guy made the comment that he misses the things that he never did anyway before COVID-19, and which I find quite entertaining. That and he said that he never used to do any exercise, but now that he's allowed to go for a walk for 1 hour a day, this was in England, 1 hour a day, he's out there looking at his watch and out he goes. He's going for his walk. That's something he wasn't able to do prior to the relaxation in England. And I'm just wondering whether or not, and I think it'll be a good thing once the constraints come off, whether or not we will go absolutely crazy with our money and be lining up at restaurants and the pub and everything else, trying to exercise our rights to go and do these sorts of things. And I think providing the disease that sits behind this, the virus, doesn't get triggered, that'll probably be a good thing, injecting all that money into the economy.
Oh, look, I think that's right. I mean, I've certainly got, I've got a list of the restaurants going to and which order we're going to them. You know, I've got to the stage where I've almost thought about what I'm going to order. And the other thing too is, I encourage people to particularly because the industries that have been hit the worst are retail and hospitality. And the hospitality industry, I've always encouraged people to go and get takeaway from restaurants you wouldn't normally go. Try and support them, because you want them there. When this comes off, and it's probably in Victoria, it's probably sort of late June, I suspect. When the restrictions come off, you want these businesses to still be there. So what I'm encouraging everyone to still spend money, to still go to these restaurants that are offering takeaway, which and try and keep them floating along, so that when this thing comes off, because the longer the history shows us that the longer the economy goes into recession, the slower it comes out of it. And so I'm sort of the get out of it as quickly, get out of the social distancing, get out of the lockdown as quickly as possible, because that means the economy will bounce. But the reality is it won't bounce back to the same growth rate we had before. So in Australia, we had effectively full employment for quite a long time. We had an unemployment rate of sort of 5.1, 5.2%, and most economists will tell you that anything below 5% is pretty much full employment. So we're going to have a step change in unemployment, and we'll have an unemployment challenge that will take us 2 or 3 years to get to unwind, I think. So the sooner we come out of it, the better.
Yeah. All right. Well, that was very, 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 very enlightening. I was quite fascinated with obviously your discussion about your super and how you should be viewing it and where you should be positioning yourself going forward, and also the insurance, which I didn't know about, Sharlene. So I'm thrilled about something positive in my world that I wasn't aware of. But the takeaways, I guess, are start when you're young and put money into it, because it'll be important for you when you retire. The more money you're going to have in your pocket then, and getting the money in early, I think, is the other message that you're delivering, and let it compound all the way through. And the last thing I heard, Jarrod, was that I need to get to the pub and to the restaurants as soon as I can to do my bit for this country.
That's correct, and that's what I'll be doing.
So, Sharlene, is there any last things you'd like to be imparting to our audience about what they should be doing in this space?
Yeah, protect yourself, obviously with washing your hands and all that sort of stuff, but also financially protect yourself. Have a look at your super. It doesn't take very long. 30 minutes a year, I reckon, is all you spend on it. And please don't hesitate to look me up on our website and give me a call if you've got any questions. All
right, thank you.
Oh, and sorry, one last thing. In no way, shape or form today have Jarrod or I given any personal advice. It's all been of a general nature only.
Thank you.
Thank you. Love the lawyers involved in everything. And Jarrod, your closing comments?
My closing comments are, super's a long-term investment. Please don't panic. We will come through the other side of this. The economy will recover. Your super fund balances will recover. And if you're worried about it, call us before you do anything. Because we're here for you. Just call us. That's great.
That's great. And we learned something about this. So now when I see it on the television, I'll understand the absence of shareholders is why we do better in industry funds. So thank you. Thank you for your time. As you said, you're very, very busy right now, responding to a lot of calls, and I'm not surprised about that. So thank you for the time you've taken today to provide some insights into superannuation in our industry.
Fantastic. It's a pleasure.
Thank you.
Thanks.